Inflation is the general increase in the price level of goods and services over time, leading to a decrease in the purchasing power of money. In investment appraisal, inflation must be carefully considered as it impacts both future cash flows and discount rates. For companies making long-term investment decisions, inflation affects the real value of cash flows and must be factored into financial models to prevent overestimating future returns. Future cash flows can be presented in either real terms, adjusted for inflation, or nominal terms, including inflation, with different approaches used depending on the situation. In nominal terms, the cash flows include the impact of inflation, while in real terms, inflation is stripped out to provide a clearer picture of the project's underlying value. When calculating net present value, NPV, or other appraisal metrics, the choice of inflation method will influence the accuracy of these projections. If inflation is anticipated to rise, it's important to adjust both revenue growth and cost projections, ensuring the project reflects realistic economic conditions. Additionally, inflation influences the cost of capital, as higher inflation generally leads to higher interest rates, increasing the overall cost of financing. Managing inflation expectations is key to accurate financial forecasting and sound investment decisions. The impact of inflation extends beyond cash flow adjustments. It also affects the financing costs of projects. If inflation is expected to rise, the cost of borrowing typically increases as lenders demand higher interest rates to compensate for the reduced purchasing power of money over time. This is particularly important when assessing capital investments or projects requiring significant upfront financing. To account for inflation's effects on financing, companies must incorporate a real rate of return, adjusted for inflation, and a money rate, which includes inflation, when calculating the project's required rate of return or cost of capital. If the project is financed through debt, the real value of debt repayments may decrease in an inflationary environment, but this may be offset by higher interest payments, potentially eroding the project's profitability. Additionally, inflation can impact the operational costs of a project, especially when input prices for materials or labor rise. Accurate inflation forecasting is essential for managing financial risks and ensuring profitability. Companies must monitor inflation trends and adjust their financial models accordingly to avoid overestimating returns or undervaluing future costs. As part of a comprehensive risk management strategy, inflation should be considered alongside other factors, such as tax rates and working capital requirements, to ensure a robust and realistic financial plan. Taxation. Taxation plays a critical role in investment appraisal, as it directly affects the profitability and cash flow of a project. Tax payments reduce the available cash that a company can use for reinvestment or distribution to shareholders. For example, taxes on operating profits reduce the net cash inflows available for future investment, which must be accounted for when calculating the net present value, NPV, of a project. The tax rate applied to the project's earnings, whether through income tax or other levies, significantly impacts the project's overall viability. In addition to tax on profits, tax allowable depreciation offers tax relief by reducing the taxable income. This depreciation is calculated based on specific rules, often involving straight-line depreciation or reducing balance methods, and is essential in adjusting cash flows to reflect real post-tax benefits. Taxation can also influence decisions around capital structure, as interest on debt is typically tax-deductible, reducing the effective cost of borrowing. Thus, companies must assess both the tax rates and the structure of the project's financing to ensure that the financial model reflects realistic tax obligations and the full impact on project returns. Forecasting tax liabilities ensures that projects are assessed comprehensively, factoring in both direct and indirect tax costs. Beyond operating profits and financing costs, taxation also impacts capital expenditure and asset disposals. When investing in fixed assets, such as machinery or buildings, companies can often benefit from tax-allowable depreciation to lower taxable income over time. The value of depreciation depends on the local tax laws governing capital allowances, and incorrect assumptions can distort cash flow projections. Additionally, the disposal of assets at the end of a project's life may trigger tax consequences, such as a balancing charge or balancing allowance, depending on whether the sale price exceeds or falls short of the book value. Understanding the tax implications of asset disposals is crucial when calculating the terminal value of a project. Taxation also affects the project's overall risk profile, as changes in tax rates or tax policy can alter the expected financial returns. For instance, unexpected changes in tax legislation can affect the viability of long-term projects, particularly in countries with volatile tax policies. To mitigate the risk of tax surprises, Companies often conduct sensitivity analyses to understand how changes in tax rates or tax treatment could impact project outcomes. Ultimately, a thorough understanding of taxation ensures that investment appraisals reflect the full financial impact, enabling informed decision-making and risk management. Working capital. Working capital management is an essential component of financial management, ensuring that a company has sufficient funds to meet its short-term obligations while maintaining the flexibility to invest in its core operations. Working capital is calculated as the difference between current assets, such as cash, receivables, and inventory, and current liabilities, such as payables and short-term debt. Efficient management of working capital ensures that a company can continue its day-to-day operations without interruption, even when facing fluctuations in revenue or unexpected expenses. Proper working capital management also allows a company to optimize its liquidity, avoiding cash shortages that might require costly short-term borrowing or lead to missed growth opportunities. Financial managers focus on maintaining the optimal level of working capital, which is neither too high nor too low. Excessive working capital may indicate inefficiency, as resources are tied up in assets that are not generating sufficient returns. On the other hand, insufficient working capital can lead to liquidity problems, affecting the company's ability to meet its obligations and forcing it to seek external financing. Working capital ratios, such as the current ratio and quick ratio, are commonly used to monitor liquidity and provide early warnings of potential financial stress. Effective working capital management is crucial for ensuring an organization's ability to grow while maintaining financial stability. Companies must balance profitability with liquidity, as tying up too much capital in working capital can reduce the funds available for more profitable investments. To optimize working capital, companies can implement strategies such as improving inventory turnover, speeding up accounts receivable collection, and extending accounts payable terms without damaging supplier relationships. For example, companies may seek to reduce their inventory holding period by improving demand forecasting, thus minimizing stockouts and reducing inventory costs. Similarly, improving accounts receivable management by tightening credit policies or using automated invoicing systems can help speed up cash inflows, improving liquidity. Conversely, extending the accounts payable payment period can allow a company to hold onto cash longer, though this must be managed carefully to avoid damaging supplier relationships or losing supplier discounts. Monitoring working capital ratios is essential for ensuring that the company maintains adequate liquidity without compromising operational efficiency. By focusing on cash conversion cycles and using working capital metrics, companies can ensure that they maintain financial health while pursuing long-term growth objectives. Ultimately, effective working capital management leads to improved profitability, greater flexibility, and reduced financial risk.